So music in the background means we're live, right, gentlemen?
Yep.
All
We're
right.
being live.
What's that?
Yes.
All right, let's get this show on the road. We are 2 minutes late. Welcome to Wall Street Beats. Happy Friday, everybody. I'm Steve Lamar. I'm joined by our banking and financials pro, Charlie Peabody, who is, we got some light on him today. He's not in Darth Vader mode. And we've got our growth and small cap pro, Robert Marson, who's going to update us on one of his old favorites that I think he's still long. So why don't we get this show on the road? Mr. Peabody, what are you thinking about this? I saw a headline this morning about the Strait of Hormuz might be closed for another couple weeks. I
You
mean,
know,
what's going on here?
I think that's the important question is what we've seen, in this, 500 point SPOOS rally. Is it flow related or is it a referendum on, an Iranian peace, or is it something about, the fundamental earnings that are about to be reported? And I I believe it's flows related. In other words, people were off sides coming into that peace negotiation. They were either short, hedged, or underinvested.
Yep.
And so I believe what you've seen is really people trying to um, reposition. And so it's not a vote on, or referendum on the peace process, and it's not a referendum on the earnings, which, by the way, should be very good. So if it is a flows issue, sometime next week, going into option expiration, we're going to find out um, how sustainable it is. So I have not done a lot in the last couple of days. I've sat back and watched. I am underinvested because I've been fairly bearish. Um, but the first group out of the box to report earnings are going to be the banks, starting on Monday with Goldman Sachs.
Yep.
Um, and before I get into that, I just want to mention, um, the Michigan Consumer Sentiment Index just came out this morning. It came out at 47.6, which is the lowest on record. So that's important that you don't have a consumer that is feeling hunky dory, because that's part of my thesis that there's a negative wealth effect developing here, particularly at the high end as not commercial, residential real estate starts to wane in value. And if stocks do correct, and that's a big if, obviously, because of what we've seen the last couple of days, I think by the end of this year, the negative wealth effect will be impinging on that consumer sentiment and result in a retraction of spending, which leads to a recession. So I'm still in that camp that there's a good probability of a recession as we exit 26.
So
Um,
Q1 numbers are going to be just fine. It's probably Q2 and Q3 that are going to really start to see the effects of these higher oil prices and these higher for longer interest rates. And I mean, it takes a while to flow through, but it's going to start hitting
yeah,
and
I mean,
hitting hard.
I call Q1 numbers EBITDA earnings. EBITDA stands for earnings before Iran, tariffs, and Donald announcements.
Got it. Okay, that's a
Um,
good one.
so we'll see what happens.
All right. So what are you? How are you positioning in front of the in front of next week? You're gonna be a busy boy next week.
Yeah, I memean, the bottom line, and I previewed this, I think it was on Monday, and I posted, my write up of Q1, the Q1 preview earnings on Wall Street Beats last night. So there's a written commentary, and then there's a verbal commentary that I gave earlier in the week. But the bottom line is you're going to take, high single digit revenue growth, and you're going to turn it into mid to high teen earnings growth for the banking industry. So that's very, very, robust. In fact, I think banks and financials in general are going to be the third best group out of the 11 S&P sectors in terms of earnings. So the expectations are high. I generally above the street. in my earnings expectations. So I expect positive surprises. The question is, are we seeing in the first half of 26 the best of the year? And that's my conclusion.
Yep.
I've done some historical analyses of correlations between bank stock prices and various bank metrics. And the one that measures up the best is what we call PPNR, pre-tax, pre-provision net revenues. Basically, it's just total revenues minus expenses, but no credit costs. And if you look at PPNR, when it peaks on a year-over-year momentum, it's usually when bank stocks peak. So PPNR this quarter, in the first quarter of 26, is going to be up about 12%. In the second quarter of 26, it should be up about 17%. But then it starts decelerating fairly rapidly into the second half and into 27. So you lose that momentum in PPNR as you move into the second half. At the same time, if I'm right about the credit cycle still having some deterioration on the corporate side, credit costs should be rising in the second half. And that means earnings growth generally should be slowing. So I think somewhere between, this first quarter report and June is when we start to see bank stocks peak and roll over. And so that's why I've remained, cautious to bearish on the bank stocks. But
Charlie, do you see a canary in the coal mine or a black swan event related to what we're seeing in private credit and all these gates that are being thrown up around redemptions? And it seems like there's some problems there.
There definitely are, and if that's in an area you want to be short is private credit. I've been beating that drum since the spring of 25, that private credit is going to be the epicenter of the next credit crisis. And the analogy that I've used from today to today is the 1907 panic, where the trust companies were the non-bank entities that blew up, and today's equivalent are these private credit companies. So yeah, I think they are the canary in the coal mine, that the credit cycle on the corporate side is starting to deteriorate. In the commercial banks, which will be they're not going to be at the tip of the spear, they're going to be at the end of the process. They've seen 5 quarters in a row now of higher C&I non-accrual loans, or what we call problem loans. C&I stands for commercial and industrial. And those are loans that do not include commercial real estate, CRE. It's strict meat and potatoes, middle market lending type of loans. It's also asset-based lending loans. That's one of the things I am going to look for in these first quarter reports next week is, are we still seeing higher C&I non-accrual loans? Because that says that the process of deterioration and normalization in corporate credit is still developing. I was going to say something else, and I forgot. Anyway,
okay.
So yeah.
Mr. Marson,
Yes.
another thought on, it looks like small caps yesterday finally got a bid. We know they like lower interest rates, which doesn't look like it's happening. Lower interest rates are obviously worse for banks, but good for small caps. And this rally has just been staggering in the last week.
Yeah.
I know you were. I think you were sitting in a lot of cash. Did you do anything when you started to see the bid, or just kind of sat back and watched? And I don't know, how are you looking at this big ramp? Is this a place you start thinking about shorting again, or where are you?
If I had to trade, I would sell or short rather than buy. Not to say you can't find an occasional laggard that has catch up side or is an arbitrage versus a peer group, and that was sort of the reason for one of my last 2 buys was the Intest trade, which there's sort of been big news on that, by the way. The CEO got fired last week. So he got fired after we doubled our money. But the problem wasn't that we doubled our money. It was that the stock was so cheap it could double. And the the numbers were sort of really bad for 25 to try.
Irrespective of the CEO.
Yeah, exactly. The performance of the management team in 24 and 25 was, was good in 24, then fell off a cliff in 25 with the Trump tariffs. And the reason, I sort of fell in love with the idea at 7 and 8 was that their peers had already doubled and tripled off the bottom, and they were still only $2 off of the bottom, and 30%. So there just seemed to be a natural catch up side to the space when the fundamentals that were filtering through to these guys, their competitors, filtered through to them, which is starting to happen now. It's the third time I've done it, and I've made money each time, and not just 50%, like 200% each time. So this is, this will be the third time, and but I'll have to do it with a new CEO. So there's risk there that the CEO, doesn't get it. But I spoke with the outgoing CEO, and he handpicked this guy and has a lot of confidence in him. I think the outgoing CEO had a bit of a feud with the board on compensation and investment for growth and versus near-term earnings. So he called the board out, and the board forced him out unwillingly. But I still think all the fundamentals are in play that got us in the stock in the first place. So I'm very comfortable owning the stock at 15 or 16 for one more X at least. So since my basis is 7.11, that would make a price target of around 22. So I'd have a triple. So that's what we're shooting.
Was he a big shareholder?
No, not really. Because he was just he was not part of a founding group or anything. He didn't have any founders equity, and they are not very generous with their options programs. So they have very little shareholder dilution. So on the on the idea of the third time's a charm for Intest, I would have to say the sixth time had better be a charm for Surrogon. Because I'm probably
6 times a bet on this one, huh? Okay.
I'm probably on my 6th pound the table. I think my table has a crack in it, a fine crack.
Your Surrogon table, for sure.
I'm pounding the table so often, yes. But the way the stock is $2.35, it's not at the very low end of the range, which is around $2, and the high end of the range might be $2.60. So it's in the middle of its 52-week range, but the 20-year range is 2 to 6, and it's hit 5 or 6 a few times in 20 years, and I would hope that they would be able to earn their way back to $5 to $6 in a year or so. I had the way last year played out. There was a couple of big customers, particularly in India and one in the U.S. that delayed or deferred major spending programs. And this business is a lumpy business. Now, a lumpy business has two sides to it, right? You could lose business quickly, big orders could be delayed, deferred, or you could also get them. And we spoke with a representative of the company yesterday, and it seems like there's more orders coming in, especially from North America and India, which were two of the areas that are their two largest revenue geographies. So that's very important. And they've had a lot of success getting interest in 4 new products. They announced at the world's biggest microwave and wireless trade show, Mobile World Congress, which was in Barcelona in January, I believe. So these guys are starting to see significant interest. There's the fact that their biggest competitor is a company called Nokia, and Nokia has put its microwave division up for sale. So that's not fun if you're a customer of Nokia, because you're very uncertain of who your vendor is going to be, right? Nokia could pull it back into the fold, but in my opinion, they won't, because it's such a challenging business relative to where they want to go into optical and data center and sexier areas. They don't want to deal with shitty microwave radio, low tech stuff. So then it's a matter of who's going to buy it. And there are not a lot of candidates to buy Nokia's business. So I believe Ceragon is trying to buy it, but they're trying to pay pennies on the dollar for revenue. And I don't know if they could afford anything more than a few pennies on the dollar. So we'll have to see if a transaction gets consummated. I don't believe Nokia has great IP, and I don't know what they get for it. They get the customer list, but I don't know how much of the product lines they even want. And the story here is that the rest of the industry is using an 11-year-old modem chip made by MaxLinear, 11-year-old technology. And our company has one they just announced last year and have it in a handful of products that are just launching. And it's far, far superior to what Ceragon used to use, which was a 10-year-old chip, and what the competitors use today. So there should be a lot of new business earned on price performance functionality, because we've refreshed our technology while the rest of the industry doesn't do their own semiconductor chips and are dependent upon a company who's struggling to make money and who doesn't want to invest in telecom, especially this side of telecom, quite frankly, because it's such a shitty business. Selling to Amazon for its data centers is a lot more lucrative than selling to AT&T for its microwave radios. So there's a whole bunch of things that are going to come together and hopefully give us a growth cycle. I would hope that as I said, the 6 times the charm. And I'll tell you a story as to why I'm giving this a third year now. Because about 2017, at half of sales, I bought a company called Calix that made telecommunications hardware. Sold to Verizon, sold to AT&T. Those guys beat the shit out of Calix, yada, yada. Terrible company, terrible fundamentals for 20 years. They had a new product. It was in development. The old product fell off faster than they thought, and they had a really bad 6 quarters. And I bought the stock so well at 5, I sold it at 8, 9 while they were doing very poorly, patting myself on the back. And 2 years later, 3 years later, I shorted that stock that I sold at 8. I shorted it at 80. So in that instance, my patience would have been very much rewarded had I had it. I was not wrong about the product cycle. I was 2 years late. Here, I'm hopeful I'm 2 years late and not wrong. But I'm willing to give it one more full year to see if they deliver upside.
Is there any kind of war discount in this thing here? Do you think is that playing into it at all?
I mean, there could be parts of the business that are affected by the war, for sure. Okay, and I mean sales. I don't mean missile hitting corporate headquarters, because a lot of other Israeli defense stocks have gone up like crazy. So there's no war discount for them. You understand? So I think that there are some people on a global stage that don't want to buy Israeli products because of what they're doing as a matter of politics. And they might be seeing that in areas, particularly Africa and South America, places like that. The other thing is that their primary U.S. competitor is a company called Aviat, and somebody posted a pretty damning 30-page report on why you want to be short the company and why they're having all kinds of financial issues, problems, and they're cooking the books. Now, if I were Ceragon, I would get that report and send it anonymously to all of Aviat's customers, right? So it's just not good for business if Aviat is the leading U.S. company market share provider. Nokia is the biggest global market share provider, are both embroiled in controversies. And the story we got from our contact was that these issues that the competitors are having, plus our new products, is getting us inside the door of every major telecommunications company in Europe, US, and a lot in Southeast Asia. So they'll have to figure out how to close deals and get purchase orders, but they're getting a lot of access to companies and prospects they never had access to in the past.
Right. Okay. All right. So you're sticking with Ceragon. You're sticking with Intest. If you didn't own them, would you be buying? Obviously, with Ceragon, it sounds like you're pounding the table. So if you didn't own it, you'd be buying it here. How about Intest?
I might even buy more here soon at this price. If the market stays where it is, which is crazy expensive in my book, I would buy more Ceragon because it's half a sales. Intest is going from 3/4 0.75 to 1.5 with its double, so
Yep.
It's not as attractive. The peers are 3 to 30. They actually have a peer that's 30 times sales, so that's interesting. I told the CEO if we can get the stock to 3, not 30, we'd have another double, and that'd be nice. And I said, that's embarrassing. If one of your competitors can get to 30 and you can't get to 3, that's pretty shitty. So we laughed about that, but we'll see if, again, I'm a solid holder. I would probably wait for a dip, although we might not see a dip. I can't predict it. I like Charlie. I'm very cautious on the economy and the stock market. And as I said, I'm just not finding much new things to buy because a lot of the names that you saw me sell that I would circle back on, Spire, my satellite company, or Arteris, my semiconductor IP company, they're, TAT, my aerospace, they all went so far above where I thought I'd be selling them that they'd have to, I try to keep a 2 times EV to sales limit. So I bought these things at 1 to 2 for exceptional growth stories, and they went to 6, 8, and 10 times sales. And I don't buy 10 times sales. I don't buy 8 times sales. I don't buy 6 times sales. So I'm selling all this stuff. I held my Electrovia despite the fact that it got to 5 times sales because there's stuff working there, right? But I'm a value guy. I like broken growth stocks when they go down to 1 and 2 times sales. And the only thing I have in that category today is SimilarWeb, but that's just too dangerous.
You're full up on that one. Yep.
Hey,
all right,
Steve, I want to mention in relation to your question about is private equity the canary in the coal mine. Every cycle there's a marquee deal that marks the peak of the cycle, and for historians, you may remember the RJR Nabisco deal in 1989, which was a ridiculous deal because of the aggressive bidding that went on to win that, and I think KKR eventually won that deal, and when it went public again in 91, it was just a crappy return that shareholders got thereafter. Then in 2007, just before the great financial crisis, the other marquee deal was TXU Corp. And the reason it was noticeable because it was huge price paid, huge leverage, and this was a commodity company. And we all know that commodities have big cyclical swings. And that company went bankrupt in 2014. So the thing that I'm watching right now is this Skydance Paramount Warner Brothers Discovery deal. It is now the largest M&A LBO in history. And the banks have to finance about $50 billion of debt. So they committed to finance $50 billion up front, and they obviously want to offload it into the leveraged loan market and the high yield bond market. And there are indications that that's the bank market's not big enough to absorb that kind of paper. So one of the indications is they brought in Apollo to do a private credit tranche, which is unique. We've never seen that before. So that's one indication that the bank market's not big enough to absorb that kind of debt. Then just this week, Citi and B of A, which were the leads on this, they did offload part of their requirements to Deutsche Bank and Wells Fargo. So they had to bring in more lead banks. So that's another indication. And then, we've had deals that recently have been hung. Qualtrics, which is a software deal, so maybe unique, but that was a hung loan that J.P. Morgan couldn't get done. They had to withdraw. And then even the deals that are getting done, like Electronic Arts, which is again another J.P. Morgan deal, required big discount financing, and the same with Sealed Air. In order to get done, it required big discounted financing and higher rates. So I'm watching this, Skydance Warner Brothers deal to see if there's any difficulties in financing it. It's not highly leveraged. It's only about 5 or 6 times, so that's not extreme. But it's the size.
So it's just the sheer size.
Yeah, the quantum is really the issue. And if there's any indication that we have hung loans and can't get that financing done, that could be a catalyst to the downside of this market. So just want to mention that.
We'll keep an eye out. When is that supposed to get done?
They're literally in the process of trying to market the debt right now. So I'm assuming that we'll
10
find
days
out.
type. Yeah.
Yeah, I mean, I don't know that there's a limit as to when they pull it, but my guess is the next week or two we're going to find out whether they can place that debt.
Okay. And then one follow-up for you, Charlie, going into next week. It sounds like you still like Citi on the big banks, on the mega cap side, bank side. You're cautious on pretty much all the others.
Yeah, I mean, there was another name I was going to mention this morning, but I don't want to, delay. It's Flagstar, which I've mentioned before, FLG.
Yeah.
I like that. If you believe that, this economy is back on track and running hot, Flagstar is a very leveraged play on an improving, credit cycle on the commercial real estate. Margins certainly should improve. Operating efficiency should improve. Capital should improve. They're going to be profitable here in the first quarter, which will be the second quarter in a row after being, losing money for 2 years. And tangible book is going to be somewhere just under $17, here at March 31st. The stock's trading at 14, and I think over the next 12 months it can trade closer to tangible book and beyond. And eventually, I think it gets sold. It's a takeover candidate.
Intangible book is what did you say? In the 20s?
Just it should come in around 17, just under $17 when they report their first quarter. They report on the 24th of April. And then to your question on Citi, absolutely, I still think Citi is the best of the money centers. I can see a $140, $150 stock price. I've been trying to be disciplined and not chase it here because I've been negative on the market. But if I saw $100, I'd step in right away.
Okay. And Flagstar, if you don't know, you'd be buying it. You'd be buying it here. Sounds like.
I have, Flagstar. I still think there's great value even at current prices. I mean, if the market sells off, Flagstar is not gonna be immune. But I bought it as low as 11 and 12, and I've been buying it as high as 13.
Okay. Marcin, do these small cap regionals ever show up on your radar? Do they ever make it into your world?
I'm in Bank Stocks Anonymous, buddy. I got an 800 number I call whenever I'm thinking when they talk me off the ledge.
All right. Sounds like you stay away. All right.
Stay away.
Let's wrap it up. Let's wrap it up there, boys. Unless you got anything else you want to talk about. It's Friday. We'll give everybody their Friday back. Thanks for joining us on Wall Street Beats. Steve Lamar, Charlie Peabody, Robert Marcin. We'll see you back here on Monday. Follow us on wallstreetbeats.com. Have a great weekend.
Thank you, guys.
Thank you, gentlemen.
Thanks, guys.